Hello people, this is Barrett from Bear Collector, and today we're going to do a pretty fun video. At least it's going to be fun for me to do, because we're going to talk about finance, mathematics related to finance, and Pokemon. So, as a matter of... Wait a minute. So, as a matter of fact, this is... I need to do some editing, because I don't want to spoil many names, but let's do it this way. As a matter of fact, this argument is part of my thesis. So, if you could read, I'll just... Model portfolio theory with parameter uncertainty. Shout out to my guitar. What does that have to do with Pokemon? So, obviously, that is something related to finance. And the main question is, I want to construct, and that's why we're going to use the whiteboard. I want to construct a portfolio with Pokemon. Okay? So, that's a goal. The goal is to construct a portfolio with Pokemon cards. Now, obviously, we want to make money, and we don't want to lose money. Okay. Now, the question is, how do we construct it? Okay, that is, I think it's a pretty good question. Now, forget it's Pokemon. Okay, and we'll get back to it. We'll get back to some assumptions that are used in the model. As I said in the last video, remember, all mathematical models are wrong, but some are useful. Okay, so how do we construct a portfolio? So you could actually think about this, and this makes absolutely sense. So let's say you want to, obviously, let's use booster boxes, okay? We're going to be using booster boxes. By the way, I'm pretty excited because I just worked out, right? Look at this. Sorry, sometimes why do I do this? Why do I rant? I'm just alone, people. I'm lonely. I'm not alone, but I'm lonely. Or am I? Anyways. God, I need to stop this. Sorry, people. My apologies. Remember, I'm just 16 3/4 after all. So, think about this. Let's say Evolving Skies has been the outperformer, the best performer of the Sword and Shield era. Okay, so let's say Evolving Skies every year is the outperformer. Okay, I don't know for a fact. Now remember, performance is measured in returns, and that is not price. Okay, so price, if it's the most expensive, it doesn't mean it's going to be the best performing. Okay. Remember that. So you want to maximize your returns, okay? So let's actually write that down. Maximize returns at max. It's not Max Verstappen, but it's maximize your return, okay? And what do you want to do? Ideally, as an investor, you want to minimize your risk. I don't know if it's probably too small, but you want to maximize your return and minimize your risk, okay? That is the formula for those green cardboardish items, sheets of papers that people usually like in the US. Over here, they're different colors because we like colors apparently, and different sizes as well. I don't know if you guys know, but euros are different size. Every bill is a different size, unlike dollars. Fun fact. So. You could think, okay, but if the best performing, once again, let's pick Evolving Skies if that's the case. I don't know. I didn't check the numbers. But if the best performing is Evolving Skies, does it make sense to just buy just Evolving Skies and just hold Evolving Skies? Because the past is telling us that that was the best performing set, the best performing asset. I think it's pretty good. I hope you guys are with me. What I'm saying is, you have an asset. History is showing us that that was the best performing. It had the max returns. Okay. Unfortunately, you know what? It's because I'm a lefty. You know, it just. Had I been right-handed, I should probably do this. Sorry, people. Okay. Why didn't I think about it sooner? Maximize returns. That's what we're doing. Okay. Should we just buy only Evolving Skies boxes in order to maximize our returns? Well, if you don't care about risk, the answer is yes. It's yes based on this model, okay? Based on, once again, I haven't mentioned the model, but if you think about it, if you look at the past, you say, okay, that had been the best performing asset, Evolving Skies booster boxes. I only care about returns. I don't care about risk. Then I only buy Evolving Skies booster boxes, and by doing so, I'm basically assuming what has happened in the past, and that is one of the strong assumptions. What has happened in the past is going to happen in the future. That is a very strong assumption that people need to remember. It's not always the case. It's not necessarily the case. Now, I'll open and close a little bracket. Remember, if you're new, by the way, to the channel, why do I know? Well, I actually showed you my thesis. I'm a mathematician, so this is what I do every day. Basically, there is the statistic tells us both frequentist and Bayesian approach tell us that to some degree, let's say looking at past returns, okay, looking at the average of past returns is to some degree kind of the best, let's say, summary of previous data that we can use as forecasts for future observation, future performance, okay? Now, please, wait there. I try to phrase it in the simplest form that I could. The matter is actually much more complicated. You just need to trust me on the math behind it, which you shouldn't. Always do your homework. Check if I'm lying or not. I could be lying, but I swear I'm not. It wouldn't be, the scientist in me wouldn't allow me to lie to other people. But just be aware that to some degree, when you have historical performance, that is kind of, when you take the average returns, it's kind of the best measure you have in terms of future, how to predict future returns, okay? It's not the best, but to some degree, it's one of the best. Now, another assumption the model makes is that, oh God, I don't like this. Sorry, people. Is this returns are normally distributed. To some degree, it's correct, especially with Pokemon. It's not the case in the stock market, but with Pokemon, they tend to be normally distributed. What does it mean? Well, let me do a nice drawing for you. Okay, so this is a line. Nice. We're gonna play the guessing game. Sorry, I'll just draw it and then I'll show you. Okay, so this is what people call the Bell distribution. I don't know. I know in English if that's in translation. Normal distribution, Gaussian distribution. Do you guys want to hear a story about this? Well, I'll leave it. I'll leave you the timestamps. So if you want to skip the story, you can go ahead. Story time. Gauss. I'm not sure how you pronounce it in English. Obviously, it was German. I think it was German. I should know it, but I'm not sure. But I think it was. I think it was German. German mathematician. I think he lived in the 1700s, but I could be mistaken. So don't quote me on that. But the story time is, he actually never claimed to be a mathematician. He always would always say to people that he was an astronomist. Yes, and he came up with the normal distribution, which I'll explain in just a second. Doing some observation, looking at planets, and it was just trying to, I think, calculate. It was looking at the orbits of planet, and he wanted to build basically a confidence interval. Basically, he wanted to say, okay, if I look, he wanted to make predictions about the orbits of planets. Okay, and he was like, okay, appears to be the orbit. Then potentially tomorrow I'm expecting that this planet is going to be right there to a certain degree of certainty. Okay, that's how he came up with the normal distribution, which it's nothing but, I don't want to go into the math of it. Basically, returns are saying this is the mean. Okay, this is the mean, and returns are going to be distributed near the mean, and it's the fact that maybe you get a day where Evolving Skies booster box drops 10%. Okay, maybe you get a day where you get a buyout, and in a week, Evolving Skies booster box go up 20%. Those basically, it's forecasting that those events are going to happen with a very low probability. Most of the time, you will move around the mean, and to some degree, that is a reasonable assumption. Okay, so 10 minutes to say all of this. Now, I never said it was going to be a short video. Because I do believe that if I want to just give you a rough understanding of the idea behind modern portfolio theory applied to Pokemon, it can't be a 5 minutes video. Otherwise, what I would be telling you, nothing really. So, that being said, those are two strong assumptions whether we need a normality, Gaussian distribution of returns, which to some degree is actually reasonable, and the fact that what happened in the past is going to happen in the future. To that, I don't know. If I knew, I wouldn't be here, people. And as much as I love you, I wish I wasn't here. I'm just kidding. I love you too much. I'll be here anyways. So maybe I do know the future. Who knows? Okay. So basically, the question was construct a portfolio with Pokemon. Okay. We were left off with basically saying, okay, what do we buy? And that is a pretty good question. What do we buy? And the better question is, why? Okay, so we want to buy booster boxes. What do? Is we look at past. I should probably just write it down. What do? We look at past performance. Okay, returns. Performance. So let's say you have 3 years of data of all Soul and Shield booster boxes and Scarlet and Violet booster boxes. I don't know, Sun and Moon booster boxes. You look at past performance, okay? You say, okay, I have this data. I have this piece of information. I know how these booster boxes have been performing, okay? And just another bracket, allow me. Remember, people, you could argue, and it's a reasonable argument. Well, but Evolving Skies did so well because look at the set, okay? I'll agree with you, 100%, 100%. As a collector, 100%. Now, as a mathematician, I'll tell you, and also this is finance, I'll tell you, well, it did so, it outperformed because it was a good set. So once the market has established the fact that it's a great set, it's a great set, so you'll see in the numbers, okay? The reason why, one set will outperform another, it's because it's a great set, so it'll keep on outperforming. If it's a great set, the set won't change. So you also need to think about it. I understand the Pokemon part of it, but I think it's also reasonable to look at the numbers. Okay. Awesome. We look at past performance. Okay. I'm actually having pretty fun on doing this video. Obviously, at this point, there's gonna be once again 3 people watching. I know 2 people will be. The third one is gonna be my wife's boyfriend, I guess. I wish I had a wife. Anyways, okay, maybe that's too much. We look at past performance and we want to construct a portfolio. How do we do it? What do we buy and why? So once again, our goal is basically, there's different ways to approach this, okay? Depending on what is our risk appetite. Now, you may ask, Barrett, how do we measure risk? Okay, many times you'll hear people talking about risk in the Pokemon market, but they're like, oh, I feel like this is risky. I feel this, I feel that. Feel is not a word in a mathematician's vocabulary. But volatility is. Actually, it's more of a finance bros who use volatility. We call it standard deviation, which is the square root of variance, okay? So volatility is a very common measure of risk. Now, there's different types of volatility, but the type of volatility where we care about is the volatility of return. What does it mean? Actually, that's a good question. What does it mean? Well, let me draw it for you. So you have your returns, okay? So I'll give you just a rough idea, okay? I won't go into the mathematics of it. So let's say returns will do this, okay? If you plot returns, that's what you'll see. Once again, this is not price. This is returns. So this is time, and this is returns. Okay? Once again, this is not price. This is returns over time. You'll see this because once again, that's the mean, that's the average. And standard deviation basically is a measure of how far away you go from the average, okay? That's usually how. It's a way. Let's say it's a way. It's one of the most common ways to measure risk. Okay, so at this point, we know we can measure returns. We can measure risk. We want to construct a portfolio. How do we do it? That's a really good question. So, allow me 1 second. So I'm gonna draw this. I'll do which case will I do? I'll do this one. Okay, perfect. So now here we're gonna need to change the labels. I'm gonna call this volatility, aka risk, and this is going to be expected petroleum. Just kidding. Returns. God, I need to stop it. Sorry, people. Okay, so what is this? It's not what you're thinking it is. You naughty, dirty beanbag, as Bez would say. So this is a line, obviously. This is nothing but a line. Okay. So once you have, let's say, identified whatever number of booster boxes you want. Let's say you want to construct a portfolio with Soul and Shield booster boxes. Okay, it's reasonable. You're like, you're thinking, okay, I don't think Soul and Shield is going to get a reprint. I have historical data, so returns, of Soul and Shield booster boxes. I can calculate not only if I have historical data, I can calculate also the volatility, aka the risk. I have this data, which is readily available. Actually, can just extract it. I actually have I shouldn't say this because it's against TCG Player. I do have a scraper that scrapes off TCG Player. I don't use it, but I have it. Should I share the code? You guys, if you're watching still, sorry, I almost died. If you're still watching, you guys let me know. Should I share the scraper? I think I will. Anyways, basically, so you have 12 sets, okay? You have 12 booster boxes. You want to compose a portfolio because you want to do what? Well, you can look at it two ways. You are scared to me. I'm afraid of the Pokemon market. I don't like risk. I want the least risk possible with these 10 booster boxes. I got you, man. So what you're going to do is you're going to solve a problem, which is going to be a minimization problem. You're going to minimize your risk given a few things, okay? Now, the math behind it is if you went to college, uni, and you did any linear algebra, you should be able to understand it. And calculus, it's not too hard. If you didn't, then I understand it's going to be very hard. So I won't tell you the mathematics behind this problem. But what you're going to do is you're going to solve a minimization problem, and that will give you this point right here. What is this point? That point is a portfolio. Sorry, I messed up. So what I meant to say is, it's gonna give you. Let me just adjust it so I don't have to explain that part. It's gonna give you this point right here. Well, actually, that was a good thing. Okay, so it'll make you think. I hope you can see that. By the way, I think you should. Otherwise, the whole video is gonna be effed up. It's gonna give you. This is a portfolio. This portfolio will have. I'm gonna use the right hand. It's gonna be hard. This risk and this return, okay, expected. So the average return, the return you should expect on average is gonna be this one, okay, and this is gonna be the volatility you expect, the risk you expect, okay. Now, why did I say if you want the least risk possible, you're gonna have this portfolio? Well, it's a good question. Well, look at this. This is volatility. The more you go to the left, the less volatility, the less risk. The more you go to the right, the more volatility. Is there a point here that has less risk than this one? No. Okay. All points lie between in this line. Okay. So that's the portfolio that will have the least volatility. What does it mean? Well, this will basically, as an output, it will give you a set of weights. So it'll tell you buy one booster box of Soul and Shield base, buy one booster box of Chill and Rain, buy 2 booster boxes of Evolving Skies, so on and so forth. Okay? Now, I'm oversimplifying here. Acknowledge that. But that's the whole idea. I'm just giving you the idea behind it. So in a nutshell, the answer to what do we buy the answer is in here. It's the set of portfolio that solves that minimization problem. Why? We just said it, because we're solving the minimization problem. So can we construct a portfolio with Pokemon? Yes. Now, let's say we're actually an evil investors. We don't care about risk. Who cares about risk? I care zero about risk. I only want to make the most amount of money possible. Well, that is the case of the original example. If you don't care about risk, you put all your money in what? Into the best performing booster boxes, which we assumed it was Evolving Skies. I'm not sure. I haven't looked at the data. But if you don't look at risk, you put all your money into the best performing one. Okay? And then in between this point, which is the point with the less risk, and the other point, so where you only buy the most, the booster box with the highest return, lie technically an infinite number of points on paper, because you cannot buy 1.327 69 to 69 booster boxes of Shielding Rain. Sorry, remember guys, I'm just a kid. No, actually, so I'll be serious here. This is very hard. This is complicated. I understand. For me, it's not. Why? Because I understand it. The problem with science is it seems complicated. Once you understand it, it's very simple. Okay. The problem is understanding it. I didn't understand this overnight. I didn't understand this in 20 minutes. Not even in a week. It took me some time, but I understand it. So I make all these stupid jokes just to, it's YouTube. We're not at uni. I'm not a professor. Or am I? So I'm just trying to make it more fun to you to watch. Sometimes I can be serious, I swear. So basically, all this nonsense, 20 minutes of nonsense to say, can you construct a portfolio with Pokemon? Yes. Using math? Yes. This is actually used these days in finance. Obviously, it's much more complicated than I explained it in finance. A good taste is my thesis. That is actually very in-depth work. That it could be used in practice in finance with stocks. But this stuff. So you can ask me, Barry. So let's say I do what you say, okay? Which none of this is financial advice. Don't do it. Don't do as I say. I don't have a degree actually. That was just a memory. I didn't even graduate high school. So we could say, okay, Barrett, but I want to do it. Will it work? That's a good question. Now, if I knew the answer, so when I say I know, it means that 100% certainty I know the answer to will it work, I wouldn't be here. It could work. There's good reasons why it could work. As I said, your best guess at the future is looking at the average of the past returns. That's it. One of your best guesses. And basically, the average does nothing but summarize past information. Okay. When you take a look, when you compute, anytime you compute an average, you're doing nothing but taking a data set and summarize that information. You're doing the average. Okay. Obviously, when you summarize information, you're losing part of that information. Okay. Let's say I take the average degree of the month of June, okay? And it's 20 degrees Celsius, okay? The average degree is 20 degrees Celsius. You may have had a night when it was 7. You may have had a sunny day when it was 30, okay? You're going to miss out. You're going to lose on that information to extract just the average. So I hope you understand what I'm saying. So in a nutshell, I'll end it here. It's going to be a good video. No one is going to watch it, but I'm proud of it. In a nutshell, yes, you can make Pokemon investing very complicated. It's not actually really complicated because all of these problems, minimization problems and other type of problems, what actually you could do is you could say, okay, I want 20% returns a year, okay? So you fix a return and you look for that portfolio that will give you the minimum risk given that return, okay? So right there, you're basically minimizing your risk given a level of return, which is also another minimization problem. And it usually solved numerically by a computer. So actually, you can ask ChatGPT to solve it. As a matter of fact, if you give ChatGPT past performance, okay, so if you give ChatGPT the data, it might be able to do it. And you ask, well, you can ask just some way or another. You can ask ChatGPT to code you something in Python, for instance, or whatever language you prefer. But it will solve you this type of problems. Okay, so even if you're not too skilled on it, it will solve it. If I see some interest, I'll be happy to share a code that will solve you these type of problems, and will construct a Pokemon portfolio using past performance. Okay. It won't take me much time to do it. So, but I need to see interest, obviously. Otherwise, as much as I love you guys, my time is also valuable. But yeah, you can do this stuff. Actually, to some degree, you could argue it's going to work. Think about it. If you put all your money, which don't do it, but if you were to put all your money in Evolving Skies 2 years ago, you'd probably be outperforming everyone. And at that time, I'm pretty sure Evolving Skies was already the best performer, probably the best performer, right? So if you think about it, it makes sense. Now here, there's a ton of math behind it that will prove you that this works on paper, and I told you why it may not work in the real world, okay? That being said, I'll end here. Once again, I could add much more to it. I could have summarized much better, but I'm human, sorry people. But just be aware that these things exist. Maybe some people are using it in the Pokemon world. It's possible. And should we start using it? I don't know. But if you enjoyed the content, I'd appreciate if you guys leave a like, subscribe. It really helps. And from your favorite mathematician on YouTube, I will see you in the next one. Ciao.